Welcome back. Today we're looking at a piece called Beyond Meat Mooning, and it's all about that, frankly, bizarre 19% stock surge BYND had on November 26th.
Right, the day after the company was ordered to pay almost $39 million in damages. It makes no sense on the surface.
Exactly. So let's jump straight into the feedback on how to make the argument here even stronger.
Okay, so the piece has this brilliant core discovery, but I feel like it's a little bit buried.
You're talking about the idea that the stock failed to crash on Tuesday after the bad news hit, and that's what actually triggered the Wednesday surge.
That's the one. It's a fantastic insight. So the analysis needs to fully exploit the uniqueness of the psychological trigger, the failure of the stock to crash on November 25, as the true catalyst for the squeeze.
Right now, it's sort of presented as a precursor, right? The stock holds at around 86 cents on Tuesday after this terrible news, and that's just the setup.
Exactly. It's just a supporting detail, but it shouldn't be. That's the central mystery. The current structure, it sort of generalizes the short squeeze. Makes it feel like any other pop.
When it was anything but.
It was a direct, defiant rejection of a huge fundamental blow. So the weakness here is that the analysis treats the verdict and the stock's resilience as two separate facts in a timeline, instead of showing how their combination created this incredibly powerful technical signal.
I see. So the short sellers were just waiting for gravity to do its thing after the news broke.
And it didn't. And in that moment, when it didn't, their entire thesis was basically invalidated.
Right. The stock holding at 86 cents wasn't just support. It was an actively established floor.
It was a statement. For anyone betting that this news was the final nail in the coffin, that failure to drop was, a sign of overwhelming confidence. So the suggestion is to flip the narrative, reframe it to elevate this catalytic non-reaction to the very core of why the stock woke up.
Which makes that 86-cent level way more important than just a number on a chart. It becomes the stress test that the stock somehow passed.
It's the pivot, the absolute psychological pivot. We have to emphasize how holding firm, despite that huge financial hit, it trapped the short sellers. They were operating on what seemed like a sure thing.
And that trap is what sprung the next day with the surge.
That's it.
So how do you actually do that? How do you make that shift clear for the reader right away?
Frame the rest of the piece as the answer to that specific riddle.
Yes. And then you explicitly link that resilience, that Tuesday non-event, to the high short interest, that 20 to 50% of the float you talk about later. You argue that the shorts were suddenly faced with proof that their catalyst had fizzled.
Which forces them to start covering.
Exactly. The buying pressure starts right there. You frame the resistance at 86 cents as the start of the wake-up call. The 19% surge on Wednesday then becomes the logical, almost inevitable conclusion of that initial strength. That really sharpens the whole argument. It stops being a story about a generic short squeeze and becomes a very specific story about a market psyche reversal.
And building on that floor at 86 cents, the real battle wasn't even there. It was just a little higher up.
At the $1 mark.
At the dollar mark, the piece correctly points out that the surge pushed the stock back above the psychological $1 barrier, which is critical for, avoiding delisting fears.
Yeah, that's laid out pretty clearly. But I wonder if we're really digging into the full impact of that. So the critical role of the psychological $1 barrier needs stronger integration throughout the whole structure, especially when you connect the delisting risk to that explosive volume.
That's the weakness. The significance of a dollar, it feels a bit isolated. It's mentioned at the top, but then it kind of gets sidelined when you get into the mechanics of the squeeze.
It's not really tied back into the why of the forced covering and the retail hype.
Exactly. And for an audience that might get delisting as a concept, but not the immediate brutal mechanics of it, why is a dollar so critical right here?
It's the so what factor.
Totally. Failing to close above $1 for, 30 consecutive business days? That triggers formal delisting warnings from the NYSE. It's not about fundamentals anymore. It's an on-off switch for institutional algorithms.
Right. I remember this from the small cap tech crunch back in 2023. If a fund's mandate says stocks have to be listed on a major exchange or above a certain price, falling below $1 literally forces them to sell. It's mechanical.
Line in the sand. And that's what gave the upward push its intensity. It wasn't just a rally. It was a desperate race against the clock.
And that urgency, it affects everyone. Institutions, retail traders.
It turns a standard short cover into this massive, decisive surge.
So how do we make that urgency feel, real in the writing?
Well, for one, when you get to the meme stock section, you have to be more specific. Retail traders aren't just betting on the company being too famous to fail in a general sense.
They're betting on it beating that very specific, very immediate threat.
Yes, the delisting threat gives them a tangible binary target. It's not just, let's push the stock up. It's, we have to get it past $1. That's what fuels the hype.
It gives the moonshot a measurable goal.
And on the flip side, for the shorts, you explain that they weren't just trapped by the rising price. They were potentially panic buying to stop the stock from holding above $1, because once it stabilizes above that level.
Institutional money can start to flow back in, or at least stop flowing out.
Right. And that fear of triggering a wave of institutional buys is a massive motivator to cover your short position. And you have to carry that all the way to the conclusion. In the bull case, the goal isn't just a higher price. It's stabilizing and holding above $1 to keep that whole ecosystem alive.
Okay, that definitely creates a much tighter, more robust structure. Now, let's talk about the feel of the piece, the reading experience. You're diving into some really serious stuff, dilution risk, Q3 revenue, debt, and then you have a title like Beyond Meat Mooning? It's a little jarring.
You know, I actually like the punchy title. It grabs you. But then the analysis jumps between that viral, internet speak, mooning, wake up, and this very dry, almost academic financial language.
And that dissonance, it just dilutes the authority of the piece. The reader's left thinking, wait, who is this for? Is it for a serious analyst tracking balance sheets, or is it for a Reddit trader chasing a squeeze?
And that confusion just undermines the message, even if the underlying facts are totally solid. So the suggestion is basically pick a lane. Or if you want to bridge both worlds, you have to be much more intentional about it. You use the hardcore financial analysis to explain why the mooning is happening.
So you use the rigor to deconstruct the meme.
Exactly. Keep the catchy title, sure, but the language inside has to be consistently sophisticated. The rigor has to be the constant, even if the packaging is a little flashy.
But what about the risk of alienating the meme audience? If you start talking about measurable volatility factors instead of, a massive hype loop, do you lose them?
That's a fair point. And it's why you have to be smart about how you translate it. If you're targeting the financial pros, yeah, you position retail hype as a volatility factor they need to model. That's their language.
And if you want to lean more into the retail crowd?
Then you take the reality check section and you make the language more vivid, more assertive. You use imagery that hits hard. Instead of just saying there's dilution, you say the shares are being watered down until they're worthless.
Okay, I see.
The lawsuit isn't just a liability, it's an immediate cash hemorrhage that the company has to survive. You use strong, clear language to drive home the risks. That way, the final verdict, moonshot or trap, it feels earned and sharp because the voice has been consistent the whole way through.
This has been a really deep dive. We've covered a lot on structure, on tone.
I think it's all there. So to recap the main actionable points for the writer. First, restructure the whole narrative. Put that catalytic non-reaction on November 25th front and center. That failed crash is the real mystery.
Second, make the $1 delisting barrier a core part of the mechanics. Show how that specific line in the sand drove the urgency for everyone involved. The shorts, the retail buyers, everyone.
And finally, harmonize the tone. Get the sensational title and the serious analysis to speak with one voice. Use the fundamental facts to either deconstruct the meme for a retail audience or to educate a technical audience on a new volatility factor.
Do that, and the sophistication of the analysis will be matched by a really compelling, coherent